Hi, good afternoon, and how are you doing today? Let me know if my audio is okay. I had shot this video before and the audio sounded low. So if you're listening, let me know if it's a bit too loud or a bit too low or just okay. I hope it's not just okay at this level because I'm literally at the top of my voice. Today I'm looking at Zenith Bank forecast for FY 2025. By my view, I had earlier shot this video a day or two ago. Upon some introspection, I had a convo with an acquaintance of mine who I would say probably being in finance or being um, a deeper analyst than myself gave me a different perspective. And I 100% agree with that perspective. Um, Originally, when I shot the video, and I have the numbers somewhere here, you would see that I had worked out a book value per share of 116 naira for Zenith. And in case you're wondering what a book value is, book value essentially is the accounting value of one share based on a bank's balance sheet. In simple terms, if you were to liquidate this bank, meaning free of everything people are owed, what do we have left after dividing by the number of shares? You get what is known as book value. Now, so my original scenario for book value was 116 naira. However, you know, or if you remember, the CBN a few weeks ago came out with a circular which says, look, banks, in essence, you guys need to clean up your loans that are problematic. You guys need to work on your single obligor limit, meaning there's a limit to how much you can lend one person. And so once you hit that limit, you either need to rework the loan or work out a scenario whereby you are back to base. So banks have that deadline to do so. And I think the deadline, if I remember correctly, I think it's about what, June or so. Correct me if I'm wrong. But anyway, there's a deadline. And banks have been reacting. Zenith Bank came with a press release. I don't think they gave enough detail. The magic numbers that people need and I need as an analyst is to say, of these loans that we have, how much are we potentially writing off? I don't know. And that has to factor into your valuation. So I have a couple of scenarios here. 5 scenarios. Scenario one, that is kind of obsolete because based on FY 2024 numbers, estimate for growth, and you work out where you'd be. I don't think that number will work because obviously you would have a slightly smaller balance sheet, a couple of loans written off. So scenario one is kind of obsolete. Scenario two, which is based on the first 3 months of the year, first quarter of the year, Q1 2025, is also kind of obsolete because it was pre the CBN circular. So that leaves me with scenarios 3, 4, and 5. Scenario 3, we knock off stage 2 loans. Scenario 4, we knock off stage 2 and stage 3 loans. And scenario 5, we knock off all those loans. Scenario 1, like I said, is obsolete. But to give some context, when you have stage 1, stage 2, and stage 3 loans, stage 1 loans are pretty much good. And what I have here isn't the loan book, is the portion of, if I can put it in simple terms, the portion of your stage 1 loan book that you're making provisions for. In essence, you're putting on a watch list. Now, stage 2 is in between stage 1 and stage 3. Stage 3 loans, totally problematic. In essence, they're almost gone bad. To put it in simple base language, stage 1 loans are fine. So stage 2 is in between stage 1 and stage 3. And so the provisions, stage 2 provisions, if I can use that term, are 653. In the article, I probably would explain, or maybe I'll go online after I've walked you stages 1, 2, and 3. Now, stage 3 loans, in essence, or stage 3 provisions I will have here, essentially, your stage 3 is the bad part of your loan book. And so this is the provisions made. Now, you, in essence, have these as provisions till you write them And I think probably I would go to Q1 numbers so you can kind of understand the movement between stage 1, 2, and 3 if it's not too complex. Hopefully, you stay with me to the end of this video. So I've worked out the scenarios and you can see the numbers you have all here. Uh, Maybe if I can put some color to it so it's easier to understand. I color it yellow. And then I have potential upsides and my view. What should I color it? Can I color it purple? That's hard on the eyes. Blue, yes. So the yellow shaded part is my different 1 year target prices depending on all the scenarios I've worked out. The potential upside, in essence, potential returns or potential difference from where the stock is as of today and hopefully a year from now, the different scenarios are the numbers I have there. So you work out everything, and in my view, this stock is a hold. Now, in simple layman's language, because people might wonder, what does a hold recommendation mean? What does a hold view mean? A hold simply says, don't buy and don't sell. So if you have it, don't buy it or don't sell it. Why do I have a hold recommendation? It's simple. I don't have enough data to accurately forecast what the book value per share will be because the bank didn't provide that. So I'm going to have to work out the different scenarios. And what if you have a scenario that is probably what? Bigger than stage 5? Then what do I do? I don't know. So the bank is a hold. Now you may argue and you would have a valid reason for saying, look, if my worst case scenario is a book value per share of 83 naira, that gives me a potential for 3% upside. That's valid, but I think the professional thing to do is to put it on hold till you have clarity. What's the worst case that might happen? Sure, I could be wrong. It's possible that the estimates I have are maybe a bit too conservative and the likes. But what's the worst case? Worst case is, I don't know, maybe I'm totally wrong. The stock goes up 20, 30, 40%. And that's fine. We can always wait till the end of the year and then decide to value it. So let me know what you think. I had promised that I was going to go to the balance sheet. So for people who hopefully are still watching till now, let's see if we can go online and you can get an idea of what I was saying. So I go to Zenith and I click on that. Oh, great. The internet is fast today. And then I go to financial statements. I go to Q1. I have a podcast episode on Spotify on Q's and K's. So if you're not clear about that, find a time to listen to it. I go to page 23, which has the numbers I need. Was it 23? Yes. So in essence, this explains why I say, right? You have loans and advances to customers. You have 12 months expected credit loss, and that is the 161 billion. Then you have 653 billion in stage 2, and then you have 215 billion in stage 3. So you add up everything together, you get a trillion, and then you have your gross amount. Now, if you go to the top, and if my math says me correct, this should be, let's go to the beginning. Let's go to the balance sheet. I know I promised to do a series on reading financial statements. I'll get around that maybe next week. So what do I have here? Now remember what I said, I think in my last video. Assets for a bank, the biggest assets are loan and advances. What do you have? 10 trillion in loans. I think this probably has knocked off the impairment classifications there. And then what are your biggest liabilities? Customers' deposits, right? So, like I said, you can do your scenario planning and all that. So I hope you found this useful. Back to this page again. Any questions, do let me know. And hopefully this audio is great because I'm at the top of my voice and my voice is spent for the day. Have a good day ahead.